For over 4 years, people have been fixated on whether we could one day see a Bitcoin ETF. Well, it appears as if today we could be closer than ever to realizing that milestone. The only problem is that the ETFs that are currently being proposed are not the kind that we were hoping for. These are ETFs that are not backed by actual Bitcoin, but rather by futures instruments. Not only will this not have the impact that you're hoping for, but it could also make the Bitcoin markets much more unstable. In this video, I'm going to tell you exactly what these futures ETFs are and what they mean for the crypto market. I also have some of my own predictions on what could happen. So if you've been considering adding more Bitcoin to your portfolio, this is a video you can't afford to miss.
In nomine Satoshi, et Vitalik, et Spiritus Crypti. Amen. Greetings, fellow pilgrim, and welcome to Coin Bureau Abbey. I am Brother Guy of the Order of Saint Satoshi, and I preside over this humble sanctuary. A word of warning before we continue with our devotions. Though I may offer educational and entertaining enlightenment here, I am not ordained to counsel you on matters financial. In short, I am not a financial advisor, and nothing preached here is financial advice. Here we devote ourselves to the pursuit of crypto knowledge. News, reviews, market moves, and coin overviews are just a few of the disciplines we study. If you would like to join our order, then gently tap that subscribe button and ring that little bell. Thus may you be called to study whenever a new video is released. One final thing, cast your eyes downwards and you will see the timestamps in the video timeline. They are there should you wish to skip ahead to other parts of the service. But remember, the truly virtuous watch the whole way through. Come now and let us tread the path that leads to enlightenment. Amen.
To start off with, I need to give you a quick overview of what an ETF is. It's important to fully understand before we dive into the mechanics. So, quite simply, an ETF, or exchange-traded fund, is a collective investment vehicle that, as the name suggests, can be traded on an exchange. These are funds that are designed to track an asset, a basket of assets, or an index. These funds then issue shares that individual retail investors can buy and sell easily. They're generally quite liquid. ETFs have been structured to track a number of assets, including shares, commodities, currencies, and bonds. These ETFs can also be developed in order to track specific investment strategies. ETFs have become incredibly popular given how easily people can purchase these shares. This can be done through a simple share trading account, just like if they were purchasing the individual shares themselves. It's also more tax efficient to invest in an ETF than the underlying assets themselves. Moreover, there are many occasions where individual investors can't invest in the underlying assets. For example, if you wanted to get exposure to the S&P 500, you technically could buy every share in the index, but that would be almost a logical impossibility, and that's even before rebalancing and additions or subtractions. Think about some of those commodity ETFs. How else are you going to get exposure to oil, natural gas, or copper? I can't imagine there are many people who will be buying these commodities on the open market in order to invest in them. So it's quite clear that there are a number of benefits that come from these ETFs. ETFs are managed by a provider that will do all the admin of buying and selling the underlying assets, storing them, reinvesting dividends and interest if it applies, and rebalancing if it's an index. Oh, and if the ETF is tracking an asset that cannot be physically bought and stored, then the provider will get price exposure synthetically using other instruments. That's how exchange-traded funds work. And given how easy they are to invest in, they have become insanely popular. The total AUM in global ETFs stands at over $7.7 trillion. So you can kind of get a sense as to why there's been so much of this optimism around a Bitcoin ETF. So let's move on to that, shall we? Ever since 2017, the crypto community has been fascinated with the idea of a Bitcoin ETF. And there was good reason for them to be so. This is because of what it could mean if a Bitcoin ETF was ever approved in the US. Firstly, a fully regulated Bitcoin ETF would open the floodgates to millions more retail investors. It would allow these investors to easily gain exposure to Bitcoin through their brokerage accounts in a tax-efficient way. It would also allow some of those large institutional investors that were worried about storing actual Bitcoin another avenue to invest. Previously, they had to rely on other fund structures like ETPs or Grayscale's GBTC shares. Now, the only problem with these was that they were not very liquid and hence not ideal for an active fund manager. For example, given that Grayscale's trust is a closed-end fund structure, it meant that the price of the shares would often differ from the actual price of the underlying Bitcoins that were backing the shares. This used to be a premium, but it has more recently been at a discount. So, the hope was that with an ETF structure, these institutional investors would have access to a much more efficient method with which to invest in Bitcoin. This would, of course, create a great deal more awareness of Bitcoin investing in the general population. But it was the impact on price that had Bitcoin hodlers most excited. This is because should a Bitcoin ETF ever be issued, it would need to buy Bitcoin in order to structure the fund. Much like the situation with Grayscale right now, where the fund holds the Bitcoin and investors buy shares in the fund. If there is a flood of demand to hold the Bitcoin in the fund, then this will mean that the managers will have to go out on the open market and pick up that Bitcoin. This could be price positive. And the more funds that are doing this and the more demand coming in, the higher that price goes. Since 2017, there have been many ETF applications. These applications have been made by firms both inside and outside the crypto space. These include the likes of ARK Invest, Skybridge, Galaxy Digital, WisdomTree, Valkyrie, VanEck, and a whole host of others. In fact, some of these that were rejected have made multiple applications, all to no avail. This was the back and forth of the Bitcoin applications for over 3 years. Many were of the view that it was just the SEC that was increasingly skeptical of crypto. The ex-chair of the SEC, Jay Clayton, has not been the friendliest voice for crypto, that Ripple lawsuit, for example. So it was with great enthusiasm that everyone in the crypto community cheered on the appointment of Gary Gensler as the new SEC chairman. That's because Gensler is no stranger to crypto. He actually lectured a course on blockchain tech while teaching at MIT. We then saw a flurry of more of these applications, and by July of this year, we had 13 applications outstanding. However, things changed dramatically a few weeks ago on the back of some statements Gary made at the Aspen Security Conference. It was at this conference that Gary made a lot of statements about crypto. For many, some of these comments were seen as quite disheartening. Now, I won't go into all of the comments here, but feel free to watch my recent video on the topic, and that's linked to in the top right. Now, one of the most interesting statements there was, quote, "I look forward to the staff's review of such filings, particularly if those are limited to these CME-traded Bitcoin futures." So, reading between the lines there, Gary was saying that the SEC would be more inclined to approve those Bitcoin ETFs that were backed by CME-listed futures contracts. In other words, the SEC does not particularly favour those ETFs that had plans to physically hold spot Bitcoin to back up the shares. Instead, the funds would have to buy futures contracts in order to create a synthetic fund that merely tracked the price of Bitcoin. Now, I was actually quite surprised by these comments and the change in narrative, and that was mainly because of a statement that the SEC released back in May of this year. It was an investor warning to all of those individuals who were looking to invest in funds that had exposure to the Bitcoin futures market. They brought up concerns around the volatility of these funds as well as the potential for manipulation in the Bitcoin spot market. So, that's weird. Less than 3 months after the SEC issued this statement, Gary Gensler claimed that he would be more inclined to approve those funds that had exposure to Bitcoin futures. Anywho, in the wake of this statement by Gary, we saw a flood of additional applications being filed, all of which focused on a futures-backed ETF. Some of these were new applicants, some were previous applicants who were rejected, and some were applicants that pulled their outstanding filings and resubmitted them as futures applications. There were even some ETF applications that jumped the gun on Ether ETFs and submitted applications for those being futures-backed. So it's pretty clear that these issuers made the determination that a futures ETF is more likely to get approved. To quote Bloomberg ETF researcher James Seyfarth, quote, "It's likely that the SEC will continue to approve Bitcoin futures mutual fund applications and then approve ETFs based on Bitcoin futures." The problem with this is the fact that these Bitcoin ETFs backed by futures are just not what the market wants. CME futures have been around for over 4 years, and institutional investors have been free to invest in them. Despite this, though, many of these investors have instead opted for other funds that gave actual Bitcoin exposure, Grayscale, ETPs, etc. But the real issue isn't really the demand or lack thereof. It's the fact that these types of ETF are less efficient, costly, and possibly even destabilizing. Allow me to explain. When it comes to a spot-based Bitcoin ETF, it's actually quite simple. All that needs to be done is that the fund will buy the spot Bitcoin, store it with a custodian, and issue the shares. There's no management required per se. The shares in the ETF that the investors hold are backed by Bitcoin held in the fund. However, when it comes to the futures-backed ETFs, the fund issuer has to invest in underlying futures contracts in order to replicate the price of Bitcoin. The goal of this is to try and create an ETF with shares that track the price of Bitcoin, even though it doesn't hold physical Bitcoin. Now, the only problem with this is that Bitcoin futures instruments are not always the best proxy for what is happening on the spot market. Given the unique idiosyncrasies in the futures market, prices can be much more volatile. Moreover, the CME futures markets are a lot less liquid than the spot market. This further adds to the discrepancies, as prices can diverge based on strong supply or demand dynamics in the futures market, dynamics which may not be playing out in the spot market. Now, it's not only that, but we also have to take into account that the futures instruments listed on the CME are not perpetual instruments. They have a delivery date, which means that they constantly have to be rolled forward into new futures contracts expiring at a later date. So, for example, the fund may go long on CME futures expiring in November. However, as we get closer to that date, they will have to close out of those positions and open positions in futures contracts that are expiring in December. Now, this, of course, adds to the costs of managing the fund, as they're having to pay fees on transactions every few months. It's not only the costs that reduce the performance here, it's the fact that you could actually be getting suboptimal performance based on how futures are generally priced. More specifically, the futures price is often different from the spot price. The futures price can either be above spot, called being in contango, or it can be below the spot, being in backwardation. Now, if these terms are foreign to you, don't worry. I've linked to some additional resources below that should help you out. Now, generally, Bitcoin futures are in contango. This means that the price of the futures instrument is higher than the spot rate. When I checked today, spot was at $48,372. However, the futures instruments had prices that were higher than that. Here you can see the prices for different expiry dates out until December. What this means is that whenever they have to roll over the futures contract into a contract that expires later, they will have to enter contracts at a higher price than those that they're closing out. Basically, they're making a small loss every time, which means in the long run, a strategy of rolling over futures contracts will deliver lower returns than simply holding the Bitcoin. I should also point out that this is not something that could be exclusive to the Bitcoin market. Roll risk happens in the commodity ETF market, and I've linked to a number of articles below that talk about it a bit more. Now, roll risk is broader than just a general contango futures market, though. It can actually further be exacerbated by the actions of the fund itself. Given that these funds have to constantly roll over futures contracts, their demand to buy the later dated contracts actually pushes the price up more. This means that the more ETF funds there are rolling over their contracts, the higher they bid up futures prices and the more disjointed it becomes from the spot market, the less the long-term returns. Not only this, but other market participants know that these large ETF funds have to buy the underlying futures contracts. This creates a situation in which they front-run their orders and further bid up the cost for the ETF issuer, a suboptimal outcome indeed. All of this could have been avoided by a simple buy and hold or hodl strategy. Continual exposure to the underlying asset without having to worry about this roll risk. Now, on top of this risk, you also have to consider the fact that the Bitcoin spot market is open 24/7, whereas the futures instruments only trade during market hours. Moreover, there could be a situation where futures trading has been halted by the CME, but the Bitcoin spot market remains open. Oh no, wait a second, that actually already happened this year. This actually happened to two Canadian-based funds that were offered by Horizon ETFs. Back in May of this year, when Bitcoin faced that massive drawback, the CME had to halt trading on account of the volatility. What this meant is that these ETFs could not buy or sell these assets. Well, two of the funds that are run by Horizon ETFs are backed by CME futures, and during the May crash earlier this year, the CME actually paused trading in Bitcoin futures. In response to this, the fund sent an alert to its market makers that it would not be able to honor buy or sell orders. This even though the Bitcoin markets were still fully functional and trading. Now imagine how disconcerting this could have been for retail investors. Market prices are falling and you want to sell your shares. However, you can't because the ETF issuer has restricted it. This could create even more panic and lead to a situation where you have a boatload of panic sell orders the moment that the futures markets open up again. These are the kind of side effects that no one has really considered with these futures-based instruments. So it's quite clear that these futures-backed ETFs are just a suboptimal fund structure in general. Yes, they are the only option for some commodity funds where they can't hold the physical asset. But in the case of Bitcoin, it's one of its primary advantages: easy storage. Heck, the fund could even use a secure custodian solution if it was worried about the risks of coin storage. So this then begs a very important question. Why is the SEC now so hot for Bitcoin futures ETFs, especially when it was so cold on them back in May? Well, there are a few theories. The official line coming from the SEC is that it's worried about manipulation in the Bitcoin spot market. Given that the CME futures are federally regulated by the CFTC, they are supposedly free from manipulation. They have more oversight. Now, this sounds quite silly to me. First of all, futures are derivatives instruments that react to price movements in the underlying asset. If there are whales that want to manipulate the spot market, then they are also going to manipulate the futures market. It's just logical. Secondly, to think that there is no manipulation going on in the CME futures market is asinine. There is a history of futures market manipulation going back decades. I'll link to this Wall Street Journal article below, but it basically goes through methods whereby futures markets could be manipulated for outsized gains. These include tactics like banging the close, where traders will try to reap excess profits in the futures markets. There are a number of other tactics which I shan't mention here in case you guys get any ideas. Moreover, as I mentioned earlier, it's easy to take advantage of ETF funds that use futures if you know they constantly have to adjust their exposure. This means that other market participants can easily use that knowledge to their own advantage, i.e. front-running. Okay, what's the real reason then? Well, if you wanted to take a more cynical viewpoint, you could ask yourself who benefits most from a futures-backed ETF. That would be Wall Street. The banks, market makers, and financial engineers that constantly feed at the trough of friendly regulation. Don't forget that these funds cost a lot to structure and maintain. They constantly have to incur trading fees in order to roll them forward and maintain exposure. There's not much money to be made on Wall Street from a fund backed by actual cold-stored Bitcoin. So, am I saying that the SEC is going into bat for Wall Street? Well, I'll leave you to be the judge of that. It's time to start wrapping this video up now, folks. Now, I must admit I was really quite optimistic about the prospects of an ETF. It really would provide a coming-of-age moment for Bitcoin. However, those recent statements by Gary Gensler have slightly taken the shine off of these ETFs. Although the CME futures instruments have come a long way, they are still far from being as liquid as the Bitcoin spot market. Structuring futures ETFs won't only have very little impact on the spot market demand, but it will also create certain risks that did not exist before. Risks that I don't think many market participants have fully thought through. Risks that the SEC itself seemed to have misgivings about in the past. Now, don't get me wrong, the approval of a Bitcoin ETF, even if it is a futures-backed one, will still be a big step for the Bitcoin market. I just don't think that we're watching our steps closely enough. I sincerely do hope that the SEC is trying to protect the retail investors here. That's its damn job, after all. Because the last thing we want is a situation where Wall Street is profiteering off of these instruments. That's it, my video on those futures ETFs. So now I'm dying to hear what you guys think. Are you similarly concerned about these instruments? When do you think we could see a Bitcoin ETF? Let your fingers do the walking in those comments down there. Oh, and while you're down there, you cannot miss my socials page. Over here, I have the only official links to the places you can follow me outside of YouTube. These include Telegram channel, where I do daily market updates, Twitter for my latest thoughts and the occasional shitpost, Instagram for memes and behind-the-scenes fun, and TikTok for upcoming videos and other goodies. All of that gold is below in the top of the description. And finally, I hope this video was helpful. Give this crypto champ a like if you liked it and a sub if you loved it. Oh, and don't forget those notifications. You don't want to miss what I have coming through. Cheerio from this crypto bro yo.